Good morning, friends. In our serial on income tax returns, this is the third one, income and dividend from shares, mutual funds, bonds, how to account in our income tax return by Rajendran Sivaramapillai, formerly advisor banking, CP. Disclaimer: I am neither an expert on income tax or tax audit nor authorized by IT department. This is purely based on personal experience through e-portal of IT department and IT guidelines and various other articles, and so please be guided by latest IT guidelines and latest amendment. Now let us see the important guideline. Number one, the periodical dividend received is captured in other sources of income along with bank interest on savings bank deposits, and IT refund interest and reflected in 26 AS and AIS, and it is automatically filled in the respective ITR returns. Number two, profit or loss at the time of sale, redemption is considered under capital gains. Generally, the capital gains rising out of sale of shares, redemption of mutual funds or bonds, etc., or even properties are considered under two major heads. One is short term gain or loss. Number two, long term gains or loss with indexing or without indexing. Now let us see in detail what is short term capital gain or loss. For capital assets, it is up to 36 months. For unlisted shares, land and buildings, it is 24 months. And for listed securities, zero coupon bonds, and equity oriented mutual funds, if the instrument is held less than 12 months, it is called as short term capital. In this 12 months category comes equity or preference shares of a company that are listed on any recognized stock exchange in India, units of UTI, units of equity oriented mutual funds, zero coupon bonds, and other listed securities. So all trading gains or loss in share market, trading in share market of listed shares, the holding period is less than 12 months. If it is disposed or sold or redeemed, it is called as short-term gain or loss. The applicability of section 111A. The short-term gain, 15% tax or gains under section 111A, excluding surcharge and cess. Other gains are taxed at regular income tax rate. Now, regarding short-term capital loss, the very important point is any loss can be adjusted against the short-term capital gain or long-term capital gain of other assets. If it is not possible, then it can be carried over up to 8. This is a very important condition or favorable condition for short-term gains. Now, how to calculate short-term capital gain? The formula for short-term capital gain, popularly called as STCG, is selling price of asset minus cost of acquisition minus allowable expenses like brokerage and transaction tax. Suppose, for example, if someone has invested in listed shares on 10th January 2023, rupees 75,000. These shares have been sold in the market on 25th May 2023 for rupees 1,25,000. From this 1,25,000, the cost of acquisition is rupees 75,000 less brokerage commission percent or whatever percent on the total turnover is less transaction tax 0.1% like TCS rupees 125. So the short-term capital gain for the financial year 23-24 is equal to, on this amount, short-term gain is taxed at 15%. In case of loss, it can be adjusted against other short-term or long-term capital gains or carried forward for 8 years as stated year. Please remember, no indexing available for short-term capital. The above example needs to be verified. Latest rates on brokerage commission and transaction tax, and here we have quoted example only for information. Now, what is long-term capital gain? The long-term capital gain in respect of capital assets, it is just the opposite of short-term capital gain. It is more than 36 months. In the case of unlisted shares, land and buildings, it is more than 24 months. In the case of listed securities, coupon bonds and equity oriented mutual funds, if the holding period is more than 12 months, it is called as long term capital. Now, the very important difference between short term capital gain and long term capital gain. Number one, it is based on the holding period. As we have seen, different holding period for listed securities, unlisted securities, and capital assets like 12 months, 24 months, 36 months. If it is more than those periods for those securities, it is considered as long-term capital assets. The second important thing is short-term loss can be adjusted from the gains of short-term capital gains or even long-term capital. But in the case of long-term capital loss, it can be adjusted only from long-term capital gains or it can be carried over for 8 years. The third important difference between short-term capital gain and long-term capital gain, indexation is not available for short-term capital gain, whereas indexation is available for long-term capital. So the next important question is, what is indexation? Indexation means the capital assets have been purchased long back, some even ancestral properties, 10 years or 20 years or 30 years. What was the cost 10 years or 20 years or 30 years back need not be the same now because of inflation. So the cost is inflated. There are two ways. One is discounting the present cost to the earlier years or inflating the cost of acquisition up to the present current year, current financial year or assessment year, whatever case may be. This index for capital assets is declared by income tax department based on the guidelines values in that respective year. Now the base year has been taken as, that means in this base year, whatever properties held earlier, whatever mutual funds or bonds held earlier will be adjusted to this base year period 100, and every year, as you have seen, this goes on. Now in the case of long-term capital assets, indexation helps us to assess what is the cost as on date. For example, in the left side we have given the table starting with the base year 2001-02 base year as 100. For the current year 2023-24, it is 348. Now for example, someone has purchased a property or invested in mutual funds in the year 2006-2007, rupees 2,50,000. The cost of inflation index as on 2006-2007 is 122, and the cost of inflation index 2023-24, it is 340. For example, the sale of that assets in 2023-24 is rupees 12 lakh. Now from this, the other permissible expenses is rupees 60,000. The permissible expenses is brokerage commission as well as your transaction tax if paid any. So cost of assets, let us first see cost of assets adjusted for inflation. The formula is the cost of CIA as on 23-24 divided by the cost of CIA as on 2006-07 into cost of assets in 2006-2007. So it is 348 into 2,50,000. The amount is rupees 7,13,144.75 adjusted to 7,13,115. This means even though we incurred 2,50,000 in 2006-2007 financial year, the due to inflation, the cost of the same assets now works out to 7,13,115. That means cost of capital assets equal to sale of assets, that is 12 lakhs, minus cost of acquisition, that is 7 lakhs 13,115, minus 60,000, the permissible expenses, is equal to rupees 4 lakhs 26,885. 20% tax on long-term capital gain and loss, if any, can be adjusted only against long-term capital gain or carried forward for 8 years. Having understood the concept of short-term and long-term gains, we will see for a salaried pension person what are the applicable forms. In the case of salaried person or pensioners with only income or dividend, you can submit ITR 1. ITR 4 is if besides your salary and pension, if you have business income or professional income like consultancy, you have to submit ITR 4. For trading in shares, mutual funds, redemption, etc., it is ITR 2 if you have only salary or pension plus bank interest. If you have business income and professional income besides pension and trading in shares, you have to file ITR 3. The last date for submission of ITR return for the financial year 2023-24 and assessment year 2024-25 without penalty is 31st July 2020. Even though some may earn less than exemption limit of 2.5 lakhs or according to age 3 lakhs or 5 lakhs, yet many are not aware of TDS deducted on interest income of NSC or bank SB or deposits and for dividends, and so for refund we have to submit ITR returns, and it is very simple and through e-portal one can file easily. In case of any doubts, feel free to write to me, chirasi to you at Gmail or Facebook Messenger. This is only for friendliest advice and not authentic and no charges in any form. Please consult your CA and verify IT guidelines for authors. Thank you very much. This is Rajendran Shivaramurthy.